are watching Darasa Online.
Welcome once again to Darasa Online. My name is Victor Francis, the Accountancy teacher. We are in the revision program, and our topic is company accounts. The first lesson, we revised on the concept of raising of share and issue of shares. So we did one question in issue of shares, and the second lesson, it was on forfeiture and reissue of shares, where also we did one question, and of course specifically was on preparation of journal entries. This is the area where most of students do mistakes. In preparation of ledger, there is no problem, but the main problem under company accounts is on preparation of journal entries. So we did all those two major parties: issue of share, forfeiture, and reissue of shares. So we are still receiving your comments and questions. Continue asking questions through the number that is displayed, and also you may email us through our email or through our website. And of course, we are going to answer all those questions and keep on doing the questions that we are displaying here. They are helpful in making this program viable. Otherwise, we go on today's lesson. As I promised you that we are going to have another lesson on redemption of preference share. So remember, our coverage was on raising of share capital, accounting entries for issued shares. These were covered in the first lesson. And of course, the last lesson was on accounting entries for forfeiture and reissue of shares. So as I've said, today we are going to concentrate on redemption of preference share. Later on, we are going to see another lesson on redemption of debentures. So let's see now what is the meaning of the term redemption of preference share. So to redeem means to purchase back. That's why even Jesus Christ is referred to the Redeemer, that he is redeeming back his followers. So when the company purchases back the shares that previously were issued to the public, we call it that the company is redeeming these shares. So redemption means the buying back of the shares which were originally issued as redeemable shares. So we redeem only the shares that were issued as redeemable. So if you go back to types of preference shares, we have redeemable preference shares and irredeemable preference shares. So in the articles of association, the company will have described and classified these specifically. If these shares were issued as redeemable, then after a certain period, the company will definitely redeem these shares. So they redeem these shares, they pay back the money from the shareholders whom holds these preference shares. This is the meaning of redemption of preference share. So far, we need to see the conditions, because as I've said that the company must describe in the articles of association. So what are the conditions for the redemption of preference share? In order the company to redeem these shares, it must at least go on these conditions. So the terms of redemption would be stated at the time when these shares were issued. Of course, before the preference shares are redeemed, the company should follow the conditions as a legal provision for the redemption of these preference shares. What are these conditions, in fact? The first one, as I've said, that there must be a provision in the Articles of Association regarding the redemption of preference shares. So you cannot redeem the preference share unless it was stated in the Articles of Association and the time when these shares are going to be redeemed. The second condition is that these redeemable preference shares must be fully paid up. So no such shares shall be redeemed unless they are full paid. If they are partly paid, let's say we are redeeming these shares after maybe we have called only, let's say you received the application money, allotment money, maybe, and first call. So the last call, assume it was not yet called up. So whenever we want to redeem these shares, it must, they must be paid fully. That means we need to call the final call first. After we receive this final call, then the procedures for redeeming these shares can be now carried on. No partly paid up share can be redeemed. So, the third condition is that the redeemable preference share holders should be paid their dues from one of the following sources of funds. So the first condition was that there must be a provision in the articles. Secondly, these shares must be fully paid up. And then the sources, the third condition is on the sources of fund. The sources of fund must come through either proceeds of fresh issue made for this purpose, that the company to get sufficient funds to redeem this preference share, they may issue other shares to redeem the preference share. They may issue ordinary share, even in sometimes preference share again, or even debenture. But basically it was ordinary shares. The second source is internal source. This is external source. The internal source, they may use the available amount, available reserves that could be used for payment of dividends. So the out of profit of the company which would otherwise be available for dividends. So we use this internal source. But the third source is the combination of the two. So we have mainly two sources, internal and external. All combination, that is the third sources, the combination of the two. If the internal source is not sufficient, so we may take part and issue part again. We issue share part and we use the internal sources available. So of course we have now obtained sufficient amount to redeem our preference share. The fourth condition is that if these shares are redeemed at a premium, so it should be provided out of securities premium or profit and loss account or general reserve. So whenever these preference shares are redeemed at a premium, so this premium must come from either the internal sources, that is profit or loss or general reserve, or from security premium if these shares were previously issued at a premium. When there is premium account, there is premium available. So then the premium on redemption may be financed by this security premium. Otherwise, the premium must be financed by profit or loss account. So, and finally, the fifth condition, where any such share are redeemed out of profit. If we redeem out of profit, so a sum equal to the nominal amount of the shares so redeemed must be transferred out of profit of the company to a reserve account called Capital Redemption Reserve Account, or CRR. So, because this profit includes amount retained in the business for either expansion of the business and the payment of dividends, so whenever we redeem capital, is preference shares, out of internal source, we need to set aside equal amount with the amount so redeemed from the profit to make this amount not available for dividend payments to replace the capital that is redeemed. So far, you have to comply with this condition. So whenever we use internal sources, we have to set aside equal amount of the nominal value of the redeemed preference shares as a reserve to CRR, that is Capital Redemption Reserve Account. These are the 5 conditions that you must fulfill as you are redeeming the preference share. Let's see now the accounting entries for redemption of preference shares. These are just general accounting entries because we said that normally redemption of preference share may be financed by main 2 sources, internal sources and external source. So either the combination of the 2. So far, these accounting entries will cater for all sources. So what are these accounting entries? The accounting entries required for the redemption of preference share include 1, when a new share or when new shares are issued at par. So if we redeem by using external source that we issue shares, especially ordinary shares, we debit bank account to recognize the amount received from the share applicants, and we credit share capital account. But when these shares are issued at premium, so far we debit bank for the amount received, including premium, we credit share capital account, and we credit again the share premium account. Of course, this is the normal accounting procedures as we did in the previous lessons when we are discussing about issue of shares. So we may also issue these shares at a discount. Obvious, we debit the amount received, we debit again the discount on issue because you are going to receive less than the actual capital. We credit to share capital account. Okay? So if these shares to be redeemed, the preference shares, are partly paid. So to convert or conversion of partly paid shares into fully paid shares, so far we debit share call account as we call those shares and we recognize to share capital account. We debit share calls account and credit share capital account. And then when we receive, we debit the bank account and we credit share call account. Then we have already converted these partly paid shares into fully paid shares. And then the redemption will be carried on. And when these preference shares are now redeemed at par, once we redeem them, what we do, we debit redeemable preference share capital account and we credit share redemption account. But sometimes this is called the preference shareholders account. Well, what if these shares are redeemed at premium? If we redeem at premium, that means we pay more than its nominal value. Then we debit the redeemable preference share capital with the total nominal value. And of course, then this premium on redemption will be an expenditure to the company. So far, we debit this and we credit share redemption account, or sometimes it is referred to preference shareholders account for payment. And then once we pay, we debit the share redemption account and we credit bank account. We are going to see it later. For an adjustment of premium on redemption. So far, as I've said, premium on redemption is an expenditure and should be offset. So it depends again if there are these preference shares were issued previously at premium. So we may use the premium to offset this. And if it is not sufficient, we may use also profit and loss account. Of course, adjustment of premium on redemption should be either in the profit or share premium, depending on the conditions. So there must be some conditions that will compel you either to use profit or share premium. And of course, the credit entry will be on the premium on the redemption account. Of course, I know that you have covered this, and if you are not conversant, go to the book of Business Accounting, Frankwood, Volume 2, especially the latest editions. You will find these conditions. There are almost 5 conditions that describes clearly how to operate this. Yes, for transferring the amount of capital redemption to reserve account, that is CRR. So, of course, it may be the sources from general reserve or profit or loss account. So we debit one of the either. If you are using general reserve or profit or loss, then it will be credited to capital redemption reserve account. So we set aside, and this amount will be retained as reserve. It won't be available for dividend payment. And of course, they can be used under the given or prescribed conditions, either for issuing bonus shares and so on. An expenditure on issue of shares. If there will be an expenditure on the issue of shares, should be paid through bank. We credit bank account and we debit expenses on issue of share account. Okay? So, as I said before, when our payment is made to preference shareholders, we debit now the share redemption account and we credit bank account. So these are the general accounting entries for redemption of preference share. But there is something very important to note here. So if you go from that book, I'm telling you to go and read those conditions, then of course we must put this clearly. So note, preference shares redeemed partly out of profit and out of fresh issue. For any redemption, if it is financed by both two sources, that means external sources and internal sources, then what are the main conditions to follow? So the redemption through new issue, one should work with the proceeds of issue. So whenever we use fresh issue, if you are using, say, part from internal sources and part from external sources. So the part from external sources, what we are going to consider very much is the proceeds received. That will be the nominal plus premium, if any. So far, so the amount, the total amount that is going to be received from outside for the share issued, it will be the total nominal share issued plus the premium, if any. the amount received will be that amount to be either deducted from the amount required to pay the preference shares, and then the balance now will go for the internal sources. So these proceeds will be now used to determine how much would be financed through internal sources. So to get the amount that is required by internal source, so we are going to take the total proceeds from issue. So far, in the assignment that you are going to do, I will include the question that will require you to do this adjustment. But for the question that we are going to do, it does not, of course, they are redeemed at par, and the preference shares were issued at par. So this adjustment, you won't see it. But in the question that you will be given as assignment, you are going to see that. So the proceeds of the new issue should be deducted from the redeemable amount to ascertain the financing through internal sources is the balance. So make sure that you take this point, you note, and as you are doing questions, you are going to use that. So there is no need of receiving or just considering only the nominal value. So we consider even the premium, because this premium is just a reserve. So the amount to be taken from internal sources now will be the difference between the total nominal plus the premium from external. Then, so from internal, we are going to take the difference. Then we finance the redemption. Well, let us see now an illustrative question concerning the redemption of preference share. Let us go for a short break. As we come back, we read the question, then we solve it. Thank you. Okay, so we are back. Let us now read the question. Statement of financial position is at 31st December 2013. You are given the details, amount in TZS, issued share capital. There are 100 ordinary shares of TZS 1 shilling each, making a total of ordinary share capital 100,000. And we have 50,000 preference shares of TZS 1 each, making a total of 50,000 preference shares. We have general reserve 50,000. Credit, we have creditors, yes, 10,000, making a total of 210. So there were non-current assets. Non-current assets are 200,000 shillings, and cash at the bank, we have 10,000. So making a total of 210 from the asset side. So the TZS 50,000 preference shares were to be redeemed at par. These preference shares are redeemable at par. For the purpose of raising sufficient cash for redemption, a further 40,000 ordinary shares of TZS 1 each are to be issued at par. So use the information provided. Prepare the reg accounts to record the redemption of preference shares, and an extract of statement of financial position is at 31st December 2013. Okay. So the question requires us to redeem these 50,000 preference shares. And of course, these preference shares are redeemed at par. So we are going only to pay the 50,000. But to finance this, so we are going to issue 14,000 ordinary share. Of course, the nominal value is 1 shilling each. So we are going to raise from external source 40,000. So these 40,000 will provide sufficient amount to redeem. And of course, because we have in the cash balance, we have 10,000. If we add with the 40 that will be received from proceeds of issue of shares, then we are going to get the 50,000 required to redeem this preference share. So automatically, if you consider this question, will fall under part reissue. So we are going to use both sources, internal source and external source. So from external source, we are going to raise the 40,000, and from internal source, we are going to raise the 10,000. So far, let us now start opening these ledger accounts to show how this redemption will be facilitated. So we start by opening the balance as shown. So we have debit, we have, yes, this is ordinary. Share, capital, account. This will be credit. Remember the amount are in TZS. Okay. So we write the balance here. That was 100. Okay, we have the preference share. We have the preference yes, share, capital, account. Remember the amount and TZS. We have also balance BD 50,000. Okay. The next balance was on, yes, general reserve. We have our general reserve account. The amount in it is yes. We have balance BD 50,000. Okay. What else? We have creditors, because creditor is not related with the redemption, and of course there is no entry that will enter into this account, so need of reopening. Likewise, in the non-current assets, let us go to cash account. That is cash account. Remember the amount in TZS. This will have debit balance. Balance go down 10,000. Okay. So we are almost done with the opening entries. So let us now see how we can finance this redemption. We are told that to finance this redemption, we issued 40,000 ordinary shares of one each, and these shares were issued at par. If we issue at par, we are going to receive the same value at nominal, and of course we are going to open up an account for application, ordinary share applicants. We open up ordinary, okay, we call it share applicants account. Amount into the yes. So it is share applicants because we assume these amounts were paid at lump sum. If we assume that it was paid at lump sum, then once we receive from them, we credit this account and we debit cash account. We call it cash. So we received 40 from them. So from share applicants 40. Okay, so we call these to ordinary shares. Ordinary share capital account, that will be 40. Okay, so we close this account. From share applicants, it is 40,000. So far, we have raised that cash to finance the redemption, and we have sufficient fund to redeem the preference share. What else? We pay now, or we redeem the preference. To redeem the preference, we recognize from the share capital. So by debiting this account to preference share holders account by 50. So we recognize this won't again be part of share capital. So we open up an account for redemption, that is preference share holders account. Okay, remember the amount NTZS. So from preference share capital account, how much? 50,000. Okay. Then after transferring the balance of share or preference share capital to preference shareholders account, we pay. So we pay them. So we have in our cash 50,000 sufficient to pay them, because we are paying, or we are redeeming these shares at par. So we are going to pay only the par value. If this share could be redeemed at premium, and of course we could have also sufficient amount to include even the premium, we could pay here by cash the amount inclusive the premium on redemption, and then you are going to adjust here for the premium. So the premium on redemption, of course, you know how to operate it. Then it will be either offset through general reserve or P&L. It depends on the internal source. Even if there could be premium balance for if these shares could be previously issued at a premium. But what if it could have either redeemed at a discount? So we could pay less than the par value. Then we could enter here cash the rest amount and be credited to cash. Then the difference could be discount on redemption, and this could be a reserve to us. So far, because we are redeeming this at par, let me show you now how we pay this. So we pay by cash 50,000. So preference share holders, we pay them 50,000. So if we pay them 50,000, automatically this account remain with zero balance. So nothing remains in the business. So unless we receive from other operations. Either we use other sources like bank balance account. Of course, these also balances. Okay, so we are no longer have these preference shares. But remember, we have paid 50,000 to redeem this preference share, but in fact, so the amount that is raised from external source was only 40,000. Where now this 10,000 comes? Of course, because we have the balance in the cash, definitely we need also to set aside this 10,000 from the internal source. This amount won't be available. Of course, if you look, this 40 comes to increase the balance of ordinary shares, and then we are reducing the capital side by 50. Then we need to replace the 10 for the preference. For the preference shares that is paid from the general reserve, to make this amount not available for distribution as dividend, and this will be reserved to replace the capital for the preference shares so redeemed. Now, so we need to set aside to CRR the difference between the amount received from external sources and the amount of nominal value of paid up preference shares, of the redeemed preference shares, and that will be 10,000. So we create it to CRR. How much? This is, yes, 10,000. Okay. We open up. Let me open here the CRR account. Okay. We open up here the capital redemption reserve account. Yes, comes from general reserve, that is 10,000. Okay. If it is 10,000, then this should go for balance CD 10,000. Okay. So here we remain with balance CD in the general reserve of 40,000. That is 50. That is 50,000. So this is balanced here. This is balanced. Yes, we balanced the ordinary share capital by balance CD. Okay, here if you add up, you get 140. Okay. Here we have 140. 140. Okay, so we are done with our ledger entries. We have opened the ordinary share capital because we have increased by 40 from the amount raised to finance the redemption. Of course, we have paid the preference shareholders. So we have recognized the preference share capital in our records. We won't show, it won't be shown in the statement of financial position. Yes, we have reduced our general reserve with the CRR. Of course, we have the CRR balance there. Cash, yes, of course, has paid the preference shareholders. So So we remain with nothing. Zero balance. Share applicants, yes. The preference shareholders already paid. Now, from the question, we are also required to show the statement of financial position. Let me show you here the extract of financial position. So, write the heading statement of financial position as at 31st. It was December, yes. December 2013. Okay, amount should be in TZS. Okay. So we start with the non-current assets. So we need to show the non-current assets. So under non-current assets, of course, we are given general non-current assets. Okay, let me write it here. The total. So in the question, you may be given in different forms, but you need to write them accordingly. So we are told that the non-current assets were 200 years in total from the statement of financial position. There were current assets. So in the current assets, they are cash, but the cash has zero balance. So I'm just showing you how you could report. So the cash is already used to finance the redemption of preference share. So nothing more in this part of assets. You get the total. So the total will be 200 from the asset side. We go to equity and liability side. We start with equity. So in the equity side, we have ordinary share capital. The balance of ordinary share capital, we have 140,000. But again, we have reserves. In the reserves, we have balance of 40, and yet we have also the capital redemption reserve, the CRR. So you take the balance CD. We have general reserve, that is 40. And again, we have, yes, how much from CRR, capital redemption, yes, reserve 10,000. Okay. Well, what else? Well, we have, yes, we have, yes, we have creditors, 10,000. That is current liabilities. In the current liabilities, we have creditors. How much for creditors? 10,000. Okay, so we have entered all the information. Let's see if it is balancing. 140,000 plus 14,000 plus 10,000 plus 10. Yes, it is 200. Okay, so our statement of financial position balances. So this is how you could do as the procedures for redeeming the preference shares. Okay, so far this marks the end of this session. So I request you to keep on revising, do many questions. Then we are going to post a question on this part because it is now displayed. Do it. It contains almost the same procedures that we have done, although it will include issues related to premiums and so forth. So, but I've shown you almost how you could do it. This part is not that much difficult. If you do more revision, you do more questions, you are going to make it better. Otherwise, it is time now to ask questions through the number, through our email. Keep on sending or keep on asking those questions, and we are going to answer them accordingly. So for today, we have seen how to prepare ledger accounts and the statement of financial position for the redemption of preference shares. And in the next lesson, if God wishes, we are going to have a good subtopic in which now we are going to see the redemption of. Don't miss. I hope you have enjoyed the lesson and you are going to enjoy more and more. Thank you. Don't miss the next lesson.